what do I do with the money in my Plan 3 account? Do I leave it there, stick it on my mattress, bury it in a hole in my backyard, buy an annuity with it? What do I do? We're going to be diving into that question, and I'll talk about the different options that you have with that money. After we address that, we're going to start answering listener questions. And today's question comes from Reggie, who asked us if we could revisit the impact that fees have on your investments. So we'll be diving into the fee conversation and then specifically the type of impact fees have on your overall retirement plans. I'll also be talking about the IDF, which is the investment decision filter that you guys can use as a framework to run all of your potential financial decisions through to see if it makes the most sense. So be sure to stick around to the end to find out what the 4 steps are of the investment decision filter. All right, so now to answer the initial question, what do I do with the money in my Plan 3 retirement account? So you need to remember that the money in Plan 3 is absolutely hands off until you separate service. You don't have to retire, you just have to separate service. So remember with DRS, they define those terms differently. Separate means I'm no longer working for the state or for that employer. Retire means I'm collecting a pension. So when you and me think about retirement, we just say, hey, we're not working anymore, we are retired. The state defines those two terms differently. So you could totally be retired in our terms, but as long as you're not collecting the pension, you're considered separated in the eyes of the state. Therefore, you can go in and start taking money or moving your Plan 3 retirement account around. So as long as you're not actively employed by the state, you have access to your Plan 3 money. So as far as what your options are to do with it, if you're still employed, the only thing you can actively do is rearrange the investments or change those up around. So within Plan 3, there are 2 sleeves. So there's the Washington State Investment Board, or the TAP side of it. And then they have something called self-directed, where they have the target date funds and a few other options to choose from. They're separate sides. At any time, you can switch between the two, but it can take some time to transfer your money in between. So for example, if all your money is currently in the WSIB TAP fund, and you want to move it to self-directed, keep in mind that it is going to take up to 60 days to transfer. Why? Because the TAP fund is essentially a holding fund for the TAP annuity. And because of that, they have certain rules. So for example, they only sell off any pending transactions on the 28th of every month. So if it's currently the 17th of the month and I put in my notice that, hey, I want to move money, or even if you're retired and you want to withdraw money from this account, nothing happens until the 20th of the month. So you can put it in at any time you want to. So if you put it in on the 29th, you got to wait a whole month and then some before they actually put the sell order in. So you got to wait that initial time frame. After it sells, it then has to sit in a holding account for 30 days. And then on the 2nd of the following month, you would have the money liquid. So what does it look like on a timetable? So if let's say it's January 1st and I said, hey, I'm going to move to self-directed. I put my order in on the 1st, nothing happens until the 20th of the month. So I already waited 27 days for it to happen. And then it has to sit in a holding account for 30 days or a whole nother month. So all of February, it would sit in a pending account. And then on March 2nd is when the funds would actually be available to trade inside of self-directed. Again, if you were retired and you left your money in WSIB and you said, hey, I need to take a couple grand out for whatever you needed it to, you still have to wait the same 60-day period. So if you do nothing else, and if you want to leave your money with Plan 3, at least move it to self-directed prior to retiring. You want to put this in a couple months ahead of time, the order, just so when you need your money out in retirement, you're able to get it within a week and not within a couple of months. So it's going to save you a lot of stress and hassle if you get this taken care of now as opposed to waiting. All right, so for everyone that's retired and actually has access to money, what do we do with it? So the most common thing that most people I've talked to do is they'll go ahead and move it into their own IRA or individual retirement account. When you do this, the money comes out of Plan 3, goes to your own account. The benefits of it is you're able to invest it however you want to. So remember, within Plan 3, we're limited to what their investment options are and the fees that they charge. If I move into an IRA, the doors are pretty much open. You can invest anything you want to. You want to buy individual stocks, individual bonds, mutual funds, ETFs, whatever you want can be owned inside of an IRA account. And then depending on what fees those institutions charge, you might be able to lower your fee or your fee may be higher depending on the institution. So people move out of Plan 3 to IRAs for more diversification for investments, also for quicker access. So with DRS, you have to wait, 1 to 2 weeks. With your own IRA accounts, you can set up direct deposit. And if you have cash on hand, money comes out same day, next day, oftentimes. And if you have to sell position to raise cash, typically you gotta wait, 2 days and then it's there. So it's so much quicker and easier to get money out for retirement when it's in an IRA as opposed to leaving your Plan 3. IRAs are also eligible for doing certain tax strategies, such as Roth conversions, QCD, which is qualified charitable distributions. Basically, when you're 70 and a half, if you wanted to write a check from your IRA to a nonprofit, you could do so and not get hit with a tax bill on it. So it's a way to more efficiently transfer money or give to the charities or organizations you care about in retirement. That's not available if you leave your money in Plan 3. Now, when you move your money out of Plan 3 to an IRA, as long as you're going into a pre-tax IRA and not a Roth IRA, there are no taxes due. When we move like to like or pre-tax to pre-tax, there are no taxable transactions. Now, you will get a tax form, and it's going to say the total amount that got moved, but the key before you freak out when you get a tax form for several $100,000 is just showing you how much money was transferred. Now, if you do decide to move money out of Plan 3 into an IRA, keep in mind that you are forfeiting your option to purchase a TAP annuity, which is one of the highest paying guaranteed annuity contracts out there. Make sure that you don't need additional income on a guaranteed basis before you move money into an IRA. And that actually leads us into the second thing that a lot of people do with their money is they go ahead and purchase annuities. Now, the state has been cracking down on the purchase of private annuities lately. In fact, I've seen on their paperwork where you can no longer move money directly from Plan 3 into a private annuity. You pretty much have to put it into like your own IRA and then transfer after the fact. There's no direct move from Plan 3 to a private annuity. Currently, at least that's what the paperwork says. So when it comes to annuities, there are two key types. Now, if you're thinking like, I don't need an annuity, I heard annuities are expensive, why would I ever use one? They're terrible investments. It's important to keep in mind and realize that you already own two annuities. Social Security and your state pension are annuity contracts. They just call them something differently. When you get down to the core of what an annuity is, it's a contract that pays you guaranteed income for life. Social Security, you pay into your own career. It pays you a guaranteed income stream for as long as you live. Your state pension plan pays you a guaranteed income stream for as long as you live. So it's important to keep yourself in check and say, I hate annuities when you already own two of them and it's paying out 80% of your needs in retirement. When you look at purchasing an annuity, and you can purchase annuities in different ways. You can use like the TAP annuity, but if you ever bought service credits from the state or bought time back or bought credits from a time you had in another state, those are all going to different annuity pools with the state. They might say, hey, you're purchasing service credit. And you're like, oh yeah, I'm just trading some money for some years so they can add to my pension. It's technically a service credit annuity. That's what it's called if you dig into the fine print of it all. So everything is pretty much an annuity that pays you guaranteed income. The TAP annuity is what's known as a single premium income annuity or a guaranteed income stream. So there, like I said, there's two types of annuities. One pays income for life. The other type is set to protect or grow your retirement assets. So if you need income, you want to purchase an income annuity. Now it's important you go for income annuities and not try to put it into some weird thing that's going to say, hey, we're going to grow and protect your money and pay you income. You can't have your cake and eat it too. You got to pick one or the other. Do I want protection? Do you want growth? Or are you looking for income? So if you're looking for the highest income possible, as much as I hate saying it, the TAP is still the way to go. They pay more than any private annuity out there. Now I'm licensed to sell private annuities, and I would love if there was a product out there that could compete with the state. Unfortunately, it still doesn't exist. So if you're looking for the highest paying annuity out there, TAP is typically the way you want to go. It also has a guaranteed 3% cost of adjustment, which is something you cannot find in the private market without purchasing it, which it really means having to take less income or put more money in for that same benefit. So the TAP annuity is by no means something that you should just brush off without actually considering the impacts it has. If an advisor tries to talk you out of using TAP annuity, you want to see who they work for and how they're getting paid. 9 times out of 10, they're trying to steer you towards one of their company annuities so they can get paid. I've lived that life early in my career, and so I can speak from experience that that's typically going to be the case. So if you're looking for annuities that are going to pay the most, that most advisors don't recommend because they don't get paid, that's the TAP annuity, why they seem to get a lot of hate. Now on the other foot, if you're looking for something that I don't need the guaranteed income aspect of it, but I want to take the risk off the table. I don't want to deal with the market fluctuations for at least a portion of my money. That's when you want to look into protection type of annuities. Most common ways I see a lot of people do this is using something called an index annuity. For the most part, money goes into the contract. They guarantee you no losses, and then they'll cap your gains. So let's say we'll give you growth up to 6% or 8% a year. So if the market returns 10%, you get 6. If the market loses 30, you lose 0. We're getting full protection for limited upside. And for a lot of people, that makes a lot of sense. If you can eliminate all my risk and give me a little bit of growth, I'm happy with it. And for a lot of retirees, they can resonate with that statement. At least having a portion, maybe not all your money in it, a little bit in there so you can have some stability down the road. Now, the other trade-off with those type of annuities, if they're going to protect you from losses, is they're going to have to lock up the money like a CD. So you're going to have to commit to this thing for a period of time, whether that's 5 years, all the way up to 10 years, it's up to you. So they have many different annuities that will lock money up for that period of time. Doesn't mean there's no access to it. A lot of them will give you 10% access per year type of thing, which is why it's important that you don't want to put too much in there. Always have a liquid pool of assets to meet any kind of needs you'd have ahead of time. Now, what should you not be doing with money from plan 3? I typically have 2 rules here. The first thing you shouldn't do is take all the money out and put it in your bank account under your mattress in the backyard. Why? Because this is a pre-tax account. Every dollar you take incurs federal taxes. And if you take the lump sum, all several $100,000 at once, you're immediately going to bump yourself up to probably the highest tax bracket and lose over a third of it. So unless you want to give up a whole third of it all at once, that's not the most efficient way to do it. Even if the goal is to get it into your bank account or Roth or something like that over time, typically spacing it out over several tax years and just doing enough so we can stay in the low tax brackets will net you more money in the long run and pay less in federal taxes. If your goal is to not get killed in taxes, then you want to have some kind of strategy in order to do that. So lump sum, you probably want to avoid it if you can to save the most in taxes. Second thing, and this is something even though I've been talking about this for years, I still see it happen all the time. I really just don't understand it. And that is people taking money out of their retirement account to pay off their mortgage. I get it. We don't want debt in retirement. It's a lot easier for income purposes. But to take $100,000, $200,000 out, eat a 24 to 32% tax bite on it just to pay off your mortgage and save on the 3 or 4% interest rate just doesn't make any sense. Why do you give the IRS a quarter of your retirement and just to save 4% from the bank? Like, in no way does that really make sense in my eyes. Any clients or former clients that made this move ran out of money, and sad to say that it's not looking good for them. And obviously they're no longer clients. If you're not going to listen to the advice and still make these type of mistakes, then unfortunately we can't really work with you. I've seen clients do this, and despite our warnings, they go ahead and do anyways, and it's never ever worked out for their benefit. They're in their early 60s with little to no money to their name, and that's just downright scary in my opinion. In fact, I had another former client this past year. She didn't use money for herself, but she actually gifted the money to a kid to put as a down payment. So she gave him over $150,000 for a down payment on the house. And I know interest rates are high, 6-7%, but $150,000 for a down payment on a home just seems absolutely nuts in my opinion. I don't understand why you'd ever want to put so much down the home and lock it up, especially if it's not for you and it's all pre-tax money. So now her tax bill, you take that $150 plus she already made 6 figures because she just retired. She's going to be $250,000 of income as a single filer. She's going to get a really big tax bite this year. Plus she's got nothing to help fund retirement in the future. And while teachers have it good in terms of getting income from pension and Social Security, there's still things that are going to come up that you may need extra money from. Your vacations, long-term care, any other type of medical events or emergencies. Hey, I got to fix my house. I got to buy a new car. Things are going to come up where you're going to need cash from. And when you deplete yourself so early in retirement, you're really just shooting yourself in the foot, and it's just not a good look. So please try to avoid paying off low interest debt with pre-tax money, because I really don't see how you could ever come ahead from that aspect. All right, so now moving on to our listener question. Question comes from Reggie, who I've actually had the pleasure of knowing for some time now. In fact, I actually coached his daughter in track when I first started coaching. Awesome athlete, multiple time state qualifier, CWAC champion, and one of the best that's ever come out of Seattle High School in high jump. Anyways, so Reggie asked if we could revisit the impact fees have on your investments. So there's kind of 2 ways to look at it in my mind. A lot of times people look at investment fees, they want to go for the lowest one because obviously the less we pay in fees, the more we keep, and it compounds on itself. But what I don't like seeing is when people roll it up. So not just the actual expenses from the investments, but they try to lump advisors like myself into that expense and see if they can justify hiring a cheaper one or cutting it out altogether and doing it by themselves. So I'm going to split this up into kind of 2 different frameworks here. So to start off, let's just look at expense fees. So whether you realize it or not, every investment you hold in your portfolio, whether that be a 403b, the deferred comp, even plan 3, has expenses or charges that incur in the back end. Now, for whatever reason, as industry rule, these fees aren't really transparent and don't show up in any of your statements. And believe me, I've tried. Even my statements for our clients, so they'll show the fee that I charge. The internal investment costs do not show up on those statements, which I really don't understand why it's like that. But anyways, just know that when you look at a statement, you see the fees and expenses that typically doesn't include the internal costs that you're incurring. That's just what the advisory fees are on the account or administrative expenses. When we're looking at investments, there are 2 main types that people are invested in. They're invested in mutual funds or in ETFs, exchange traded funds, or sometimes people call them index funds. Those are the main two boats that are in. Now, personally, I only use ETFs or individual stocks. I no longer use any type of mutual funds for several key reasons. Main one being fees. Most mutual funds are just kind of expensive. Yes, Vanguard has some, index mutual funds that are low in cost, but for the vast majority of people out there, especially if you look inside your 403B accounts, all they have are mutual funds, and oftentimes you're paying somewhere between 0.5% to 1.5% in fees. And yes, there are mutual funds that charge 1.5% or even just 1% in fees on its own. And that's, of course, in addition to whatever that company or advisor is charging. So those type of the fees, it's okay to focus on getting the least amount one. Now, when we analyze stuff, there's a framework you want to use, and I call it the IDF framework, or investment decision filter, and there's 4 steps to it. So the 4 things you want to look at anytime you're making an investment decision are, of course, the fees, the performance, the risk, and the tax impact. So if I'm comparing, mutual funds to ETFs, and I say, hey, what are the fees? ETFs typically are going to have lower fees than most mutual funds. So that counts as a win from the ETF column. Now, performance, how does performance look? If they perform the same, then they're even. From a tax standpoint, ETFs are more tax efficient than mutual funds. If you're holding these accounts inside a retirement account, whether it be pre-tax or Roth, the tax impact doesn't really matter. It only matters if you're holding it in a non-retirement account, stock account, things like that. That's when it really matters. So if you're looking at just retirement accounts, the tax impact is going to be the same. The last thing there is the risk. How much risk are we taking on? So if you did apples to apples comparison, and I had a mutual fund that had higher fees, the same performance, same impact, and same risk as an ETF, that's almost a no-brainer switch to using ETF and saving a lot of money in the back end there. So a lot of these ETFs, you can get the cost down to 0.3% or less, 0.05 in some cases. ETFs are going to usually be more fee efficient overall. So that's a big reason why I stopped using mutual funds, and my clients strictly own ETFs and individual stocks, or a combination of the two, because it keeps internal expenses low. When you own actual individual stocks, other than the purchase price of initially buying it, there is no ongoing expenses, right? There's no portfolio manager that has to be paid. So there's no ongoing fees when you own individual stocks. So when I incorporate stocks into clients' portfolios, it automatically reduces the overall fee. So instead of being 100% ETFs, if I have a portion of it invested in stocks, all right, so now let's just run individual stocks to that same investment decision framework. So when we look at stocks, how do they perform? In most cases, stocks, the individual stocks, perform fairly well. Now, that's only because they actually have a significant amount of risk to them. You're putting all your apples on one company, so it is increased risk. They don't always perform great. There's a lot of stocks that don't perform great, or you can lose a lot of money all at once. So because of the increased risk, you're rewarded for higher performance. Now, from a tax standpoint, depending on the type of account you hold it in, stocks are pretty tax efficient. Because they don't spit out capital gains unless you physically sell them, they're really good to hold inside taxable accounts as well as your retirement accounts. So from a tax standpoint, they're pretty favorable. And then the second thing is you look at the fees involved in them. So when you look at individual stocks, while they do have higher risk involved, performance, taxes, and fees are all pluses. So if 3 out of 4 look good, maybe individual stocks is something you want to hold in your retirement account. Now, of course, key thing is this risk portion. If you don't want a lot of risk, you don't want to have a lot of money in these. So a lot of our portfolios, we don't have a ton in individual stocks. We might have 0.5% here, 1% there. But overall, most of our clients' assets are inside ETFs because they're more diverse and there's just less risk involved overall. Now, what else can we run through this filter? Let's say you had some type of investment that had no fees or very low fees. But you got to be careful that you don't just jump on that, because if something has low fees, but it turns out its performance is also low, its risk is low, and has a low tax impact, you may not want to jump into that. Because what I described to you is basically a savings account, right? If I have a savings account, there's really low risk there. It doesn't perform a whole lot. It doesn't impact my taxes that much. And there are little to no fees if you have one of those, right? So you can't just go for the free or the cheap things without looking at everything else. On the same front, a lot of DIY people will try to choose the highest performing one, where they'll use like the S&P 500 index, right? So if you just look at that, let's look at the S&P now. So the S&P 500, yeah, it's got great performance. Fees typically very low. Those are 2 pluses. But what a lot of people overlook is what type of risk are you taking on with that? S&P 500, which is what a lot of people refer to as the market performance overall, when they're gauging how well the markets are doing, is quite risky. You've seen it during COVID or in 2022, how much it can fluctuate, right? You can lose 20% in a few weeks or 25% a year, and it takes some time to get that money back. So if you're not willing to take on the risk, then you might want to find something that's a little bit lower performance, even if the fees are a little bit higher. So risk is a real key part to look at there. Of course, the taxes, it really depends on where you hold it. It's our retirement account, and that's fine. If you're holding it, if it's like a mutual fund you're holding outside, you want to keep a close eye on this tax portion. All right, so now to give you guys a visual of how it actually looks like. But basically what we're looking at here is a graph, and this comes from SEC, which is the main governing body for financial services. So they have 3 lines on here. One shows the value of what it looks like to invest $100,000 and paying only 1/4% in fees versus paying 0.5% fees versus a full 1% in fees. Now the difference between paying 1/4% per year versus 0.5% a year in fees over a 20-year time horizon is about $10,000. The difference between paying 1/4% and a full 1% is $30,000. So it's not exactly pocket change there. So that's the difference that fees can have on your portfolio overall long run. Now again, if this is an internal expense that you're looking at, making the move from a 1% mutual fund to a cheaper mutual fund would make a lot of sense, as long as it checks the boxes of the filter framework. Now, if you were to look at this and try to apply it to an advisor and you said, hey, if instead of paying an advisor 1%, I moved to a robo-advisor or someone at Vanguard and paid him 1/4%, I would save $30,000 in 20 years. But I would push back on that a little bit and say, are you really though? All right, so now let's apply the idea filter to choosing a financial advisor or planner to work with. So remember, the 4 things we look at here are going to be fees, performance, taxes, and risk. Now, if we're moving or trying to choose a financial advisor and we choose the cheapest one out there, like a robo-advisor or someone with Vanguard, we win on the fee front, right? Hey, we pay less in fees, so we win here. Now, if we're paying an advisor less in fees, how's the performance going to be? Now, let's just say it's flat. They have the same investments. Then let's look at the tax part of it. If you have a robo-advisor, are they going to take the time to review your tax return with you, talk to the CPA, talk with your estate planning attorney to make sure things outside of your portfolio is lined up and on track? You're probably not. Robo-advisors aren't real people. They're not going to review anything, right? And if they did, I don't know how much you'd trust some computer or AI going through your tax returns and just the privacy involved in all of that, right? So most times when you have cheaper advisors because you try to save money on what they charge you, you're going to get hit with more taxes. And the thing is, you're not going to realize it, right? You're going to think it's totally normal. You're not going to know what strategies are involved to reduce that. Now, as far as risk are going to be higher too. Not from an investment standpoint. Your risk might be the same portfolio overall, but what other risks are involved in your life outside of investments? So look at the type of risk management tools you currently have. For example, property and casualty insurance. Do you have the cheapest car insurance and home insurance available, or do you have one that's more expensive to protect your asset? When you have, cheaper advisors that don't look at everything, they're not going to review your property and casualty insurance. They're not going to look at your long-term care insurance, disability policies. So if something happens in a different area of your life and you don't have the proper coverages, then people could potentially go after your assets, and it could just make life hell for you. So while you save money on one front because you have cheaper investment management, you pay a lot more in just time, hassle, and stress, and actual money in some cases in the other areas outside of that. So it's so important to look past investments when doing your financial planning. Remember, investments is not your financial plan. Cash flow is a part of it, but you need to dig deeper than that. Look at taxes, estate planning, risk management. You want to make sure all those are in line, and that's what completes a financial plan. Now, if you're ready to take the next step and you really want to get a financial plan built specifically for Washington State employees, then I encourage you to take the next step and book the initial consultation call with us. We'll be happy to go through any questions you have, and we'll help you to point out some areas in planning that you may be overlooking or may just be confusing to you. We'll bring those to light so you can kind of see what's out there and if it would make sense to move forward with getting a financial plan done or not. Now remember that in each episode was saying your future depends on what you do today, and that's because it really does. The longer you wait and put off this kind of stuff, the harder it is. Waiting until you retire before contacting someone like me and saying, hey, I'm retiring, is it going to work, is a little too late. If you want to get ahead of things and really want to get things going right now, that's going to work in your best interest. When it comes to financial strategies, especially when it comes to tax planning, there's not a lot of quick wins. A lot of things we do are things you're going to see or benefit from till 5, 10 plus years down the road. So the sooner you start implementing these things, the sooner you're going to start seeing those benefits pay off. So I encourage you not to wait, take action now. And all honesty, it takes less time than booking your own vacation to get a full financial plan done. Getting an advisor on board, we do the lion's share of all the work. All you got to do is show up, ask whatever questions you have, and then you're all set with your financial plan. So if you want to hit the easy button and get things done, I encourage you to schedule a call with us. And until next time, always remember that your future depends on what you do today.